Okay, just to give you an idea of why I'm up here talking about luxury goods. The background to our firm is that we're a stockbroker based in Hong Kong and also an investment bank. We primarily focus on Asia. Our parent company, though, is Crédit Agricole, who you might know is one of the biggest banks in the world, based in France, who also deal with the luxury goods sector. We're one of the key advisors to LVMH. In terms of what I do on the research side, essentially what we do in research is we have it broken down into industries, whether it's the banking industry, whether it's the commodity industry, and in my case it's the consumer and gaming industry. So what we essentially do is identify key themes within those industries and try and encourage our clients, which tend to be big institutions like Fidelity or Wellington, to buy and sell shares. So we're really in the business of selling shares, or getting our clients to buy and sell shares, and we make a commission off those shares. So the idea is that we have specialties, and in my case, my specialty is the consumer and gaming sector. Yeah, so as I was saying, this is my area of expertise, or relative area of expertise. And I've been looking at the luxury goods and cosmetic sector, and also the gaming sector in particular, quite closely over the last 12 years. And as mentioned, I started off working in Australia as an accountant, but then I moved to London to work at Goldman Sachs for about 6 years, specialising in companies like LVMH and Bulgari and Hermes. And then for the last 7 years, I've been based in Hong Kong, and also I spent 2 years in Japan as well. We actually published a really big report about a year ago. It was called Dipped in Gold, and the idea was to talk about the huge growth in demand in Greater China for luxury goods. And I guess we're looking at the front cover of that report, which we can make available to you after the presentation. It's about 140 pages, so it's quite a detailed report. But looking at the title, we had the second title correct, which I think it's called Luxury Lifestyles in China and Hong Kong. So we felt like we nailed it when we were talking about lifestyles, and that's been one of the key themes over the last 2 days of this summit. But we did call the report Dipped in Gold, and I think that title might have been relevant 1 year ago or even 2 years ago, but based on what I'm hearing over the last couple of days, it seems like the customer here is becoming soaked in gold. So I think we need to update that title, because I think luxury goods is becoming much more a part of people's lifestyles and experiences than it was even 1 or 2 years ago. Okay, so normally when I'm making presentations, I'm talking about luxury goods demand in China, but given that most of the people here in this room are from the luxury goods sector, I probably don't need to go into too much detail. So the purpose of this presentation was really to try and give an idea of how the financial markets look at the luxury goods sector, and I'm talking about why investors like the sector, what they don't like, what the prospects are for investments in this space over the next few years, and also provide a case study on an IPO that I worked on last year now, which was Prada, which everyone's very familiar with. Okay, so the first point is to identify why investors like the luxury goods sector. So the first point is really the strong revenue growth. So what we've done in this chart here is highlight the revenue growth for different segments in China over the next few years. And you can see that while nearly every category is growing quite quickly, you've got total consumer expenditure growing at above 10% for 5 years, which is significantly higher than what we'd expect to see in other countries. But you've got hotels and catering growing more than 10. You've got alcohol and tobacco, which is would seem to be one of the worst growing categories, is actually still growing at 5% per annum, which is actually still pretty good in the global context. But the areas which are growing the fastest are my 2 areas of specialty, which is luxury goods and also the gaming sector. And you can see that we're forecasting luxury goods growth to be close to 30% over that 5-year time frame. So this is why investors, the Fidelities, the Wellingtons, we really focus on this sector. But I think one of the more exciting points is about the earnings growth, because what drives returns for investors is not sales growth but earnings growth. So while some companies might see a good increase in sales, if that's not translating into good earnings growth or good growth in cash flow or dividends, then the shares are unlikely to be a good investment. And what we're highlighting here is that the luxury goods sector actually provides above average earnings growth. So it's not just a revenue growth story. And there's a very simple reason why the earnings growth for this sector is actually better than other sectors, and it's really because of the competitive landscape. Now, everyone who works in the luxury goods sector in this room would argue that the sector is very competitive, and I have to say it is competitive, but compared to other sectors, you're actually in a much better position, particularly if you're working for some of the top brands in the space. So what we're saying is that there's very high barriers to entry in the luxury goods sector that you don't see in other sectors like sporting goods or food and beverage or other areas. And the reason why there's a high barrier to entry is because of these 4 reasons we've mentioned here. Things we've been hearing about the last 2 days, which is of course brand heritage. So for a lot of the brands, they always talk about their story, about how they've been around for 100 years or even longer, and this is very hard to replicate overnight. And then secondly, what we've been hearing as well is that it's becoming a little bit less about the brand and a little bit more about the actual product. So product development expertise is very important, and what some of these more established brands have is have decades or 300 years worth of experience in terms of developing products, which is hard to replicate overnight. And also, these companies have been investing a huge amount in terms of brand and also marketing investments over a long period of time. And also, marketing investments and advertising spend is actually very high, particularly if you're working from a very low sales base. So for a company that's been established for a long time, you've got a high level of sales, Louis Vuitton, Hermes, Chanel, Gucci, etc. It means you can afford to spend a lot higher amount on marketing spend. And the fourth point is really the top brands get the easiest access to the best locations. And that's true if you look around any shopping mall in China, you'll see that it's Louis Vuitton, Chanel and Gucci and Prada always having the best locations. So what it means is it's very hard for Chinese brands to some degree to crack into some of these categories. Now, we definitely agree that there's opportunities for Chinese brands in areas like jade and wood and silk and other areas, but in the core categories being leather goods, in watches to some degree, I think it's going to be very hard for other brands to take share away from the European and American brands. So that, just to maybe contrast that, because I know we always think about our sector being competitive, but if you think about areas like sporting goods, I mean, Nike and Adidas have been the 2 big brands in the sporting goods industry for a number of years, but if you look in China now, you've got a whole host of other local brands that have popped up that are opening 1,000 stores per year. So some of those other categories are really much more competitive than luxury goods. The third reason why investors like the space is because the sector is actually quite big now in terms of market cap. So it's not just a story that you can't get exposure to, but the global luxury goods industry has a market cap of over 200 or nearly $300 billion US, which makes it one of the biggest sectors globally. And then if you look into Asia, and I currently specialise in Asian listed stocks, you've got an increasing number of stocks being listed in Hong Kong as well. So you have Chow Tai Fook, which did the IPO only a few months ago, which has a market cap of 18 billion, which actually makes it one of the biggest luxury goods companies in the world. And you've got companies like Prada, which got listed last year in Hong Kong as well. So, we think there'll be an increasing number of companies being listed in Asia and other parts of the world to further expand the industry. So it's an interesting sector for people to focus on. What investors don't like about the sector is really the share price volatility. So what we've taken in this chart here is a 10-year history of the LVMH share price, and you can see that it has been quite volatile. So if you go back and look at the period after September 11, the shares dropped about 50%, and then rose and a little bit more stable for a period of time. But then following the global financial crisis, the shares also halved and have since actually increased by about 3-fold. But the shares in this sector are actually quite volatile. And really one of the key drivers of that volatility is driven by these unforeseen events. Because what we argue is that within the global luxury goods sector, tourist spend accounts for about 30% of sales, which is pretty high, and for some brands it's actually much higher than that. And that's where the volatility has been introduced, because if you look at the others at 70%, typically this will be very wealthy people or people who are very aspirational. And for those people, the spending on luxury goods is actually a lot less volatile than some people expect. But the tourist spend is super volatile, because you have events like September 11 or SARS, or the earthquake in Japan, which had actually significantly reduced the level of travelling that's happened globally. And as I said, that's really one of the most volatile segments within the space. And of course, it's very hard to forecast events like September 11 or SARS or these kind of these kind of events. So therefore you've got a lot of uncertainty in the space. Just in terms of investor misperceptions, because I spent a lot of time speaking to investors about luxury goods, some pushback we have is that luxury goods is a fad, and therefore they think that sales are going to go overnight. Now, that's something that you find quite surprising because you all work in the luxury goods sector. But I do get a lot of pushback from some portfolio managers and investors who would say, they just can't understand that a woman will go out and spend $10,000 on a Hermes Birkin bag or $50,000 on a Patek Philippe watch, and therefore they think it's a fad and it's going to go away overnight. The second thing is that people are really uncomfortable with the level of fashion risk. So I think some investors' perception is that you've got some sort of crazy French designer sitting in Paris and deciding one day that his favourite colour is yellow or pink, and then going out and designing a whole collection about that particular colour, or maybe have some sort of obsession with feathers or some materials that they think will be very popular that year. So we have to try hard to explain to investors that the fashion risk in the luxury goods sector is actually quite low, and a lot of the top brands are generating most of their sales and earnings from categories like leather goods, accessories and cosmetics. So those categories which have a fairly stable level of sales over a period of time. And then economic sensitivity. I think right now, given that we're going through the European crisis, there's a lot of concerns that luxury goods sales are going to collapse. And I've actually got a chart here from Alta Gamma, who I think produced the best industry data. And if you look back over, I think 17 years, you can see that the luxury goods sector has actually been fairly stable over a long period of time. And then the only major decrease we saw was following the global financial crisis, when sales dropped by 8%. But then you can see on this chart that sales recovered in 2010 to be above the pre-global financial crisis level. So what we're always trying to argue as well is that the sales in the sector are actually a little bit less volatile than people expect as well. Okay, so I want to summarise some of the reasons why we like the sector, and some of the key takeaways from this Dipped in Gold report, which, as I said, we published a year ago. The first key statement we made in this report was that we felt that from 2010 actually, that the greater Chinese demand as a percentage of total luxury goods would grow from 15% of total in 2010 up to 44% in 2020. So we thought that in 2020, greater Chinese demand being 44% of the world total was a pretty crazy and aggressive number, and it got us loads of headlines. And the report was mentioned many times in the Financial Times and the Wall Street Journal and various places. And people accused us of just trying to grab headlines. And what we realised after about 6 or 9 months is that we made a big mistake. And the mistake we made was that we were much too conservative in terms of our estimates. So what happened in 2011, which everyone's familiar with, is that the sales of luxury goods to greater Chinese people actually increased by between 50 and 100%. So our 20% forecast for that year was grossly inaccurate. And now we've recalibrated our forecast. And we're now saying that the greater Chinese demand will increase from 20% of sales up to 52%, which really is extraordinary, and we really feel very comfortable with this forecast. So if you had a ruler, what you would see is that if you look at 2020, you would see that greater Chinese demand for luxury goods would be the same size as the global luxury goods market right now, which is pretty amazing. So, we feel a lot of confidence in this forecast. I spent a lot of time, well, from an analyst point of view, I've been looking at the luxury goods sector for more than 12 years. I lived in Japan for 2 years and followed the Japan luxury goods story pretty closely. And we think, for a number of reasons, we think that the greater Chinese will compound at 20% per annum for 10 years, so really aggressive forecast. And then secondly, just showing in more detail about the countries, of course we expect Macau, China, Hong Kong, and the Asian markets to have the fastest growth over the next few years. Now we've got UK in there, which seems a bit high, so I have to check that number, but of course the reason why the UK should grow quite strongly is because of the tourist spend as well. Now, the question that we're receiving most from investors currently is that because of the European crisis, it should mean that the global luxury goods market is going to collapse. And what we're trying to highlight in these charts is that during the global financial crisis, sales in places like Hong Kong and China did fall quite sharply. And in the case of Hong Kong, the growth rate went negative. But in China, it never went negative, and also the rebound was quite strong. So we think the outlook is actually still pretty good, although what we're telling people right now is that the growth rate for luxury goods demand in China is going to slow down quite significantly this year, because last year, as I mentioned, 2011, the growth rate was between 50 and 100%, so it's very hard to expect that growth rate can be maintained. But we do believe the growth will slow down to about 20% for this year, which is still pretty good. The other point we make to investors is that we think the luxury goods sector is actually in pretty good shape now versus the credit crisis or the global financial crisis. And what we're saying is that nowadays the European brands essentially have a much higher level of exposure to retail. What happened in the previous downturn, particularly in the US, a lot of the department stores heavily discounted product. And you might know the example of Saks, who cut prices by 70% before Christmas in 2008. So this obviously really upset the luxury goods companies and it caused margins to collapse during that period. So since then, a lot of the companies have been shifting away from wholesale and going via their selling more through their own retail, which of course would start to include more e-commerce as well, which we've heard a lot about the last 2 days. So that, I think, would ensure that the volatility and revenue growth should be a lot lower this time around. Secondly, the exposure to Asia has increased substantially. So therefore, the dependence on the European market and the US market is decreased substantially. So, as we expect Asia to hold up quite well, we think that the decline in sales is going to be a lot less. And then more specifically, if we look at China, China's obviously become a much more important market for the global luxury goods companies. And in the case of Prada and Gucci, they're generating between 30 and 35% of the sales to Chinese people. In fact, if you include Hong Kong, it's closer to 40%. So as we expect greater Chinese demand to still average about 20% over the next few years, when the Chinese component is already so big, so if you have 30-35% of the market growing at 20%, it means your overall sales growth is still 6% before you start to add in all the other countries. So the growing importance of China and the still very good growth rate means that the global luxury goods sector is actually in pretty good shape going forward. And then the last point is that the inventory levels at the retail level seems to be much lower now versus the previous downturn as well. So we shouldn't see, if there is a little bit of sluggishness in terms of sales growth, we shouldn't expect to see the same level of discounting that we saw during the previous downturn. Okay, now we've done heaps, loads of these charts on the penetration of luxury goods in China. I've never really found the best way to do this. We do this thing where we divide the luxury goods market by the GDP using PPP. I've got a bunch of associates that run all these charts, so I can send you these charts if you like. But basically what we're trying to show here is that the penetration rate of luxury goods in China is very low versus places like Hong Kong and Singapore. So therefore, China for us is not a cyclical story. So if we see a slowdown in the property market starts to slow down, or if there's other macro slowdowns in China, we don't think that's going to impact luxury goods demand significantly in China because the base is already is actually very low. So there's still a lot of people earning more money. Average incomes growth in China this year should be about 15%. We've got a lot more people coming into the market. The middle class is growing. So we think it's a structural story versus a cyclical story. And then we've got all these other charts as well showing the luxury goods spending per capita versus GDP. But basically the takeaway here is that as GDP increases in China, we think there'll be a significant increase in luxury goods. As I said, we've got loads of these charts. If you want any of these, we can send them over to you. And then one other way to look at it as well, you can compare China to Japan and say, compare the number of high net worth individuals in China versus Japan, and you can compare it to the number of luxury stores. And you can see that the number of stores in China is quite low versus Japan, given the number of high worth individuals. Okay, so I've just sort of put here on one slide the three drivers of our aggressive forecast, and the first one being economic factors such as rising income. So it's just one bullet point, but in fact CLSA's have written literally thousands of pages about this point over the last few years. It's obviously rising incomes, increasing consumer credit, falling savings rate, the change in the urbanisation rate, the demographic changes as well. So we've got lots of information about this, but I've just summarised it with one bullet point there. And then secondly, a point that I don't need to talk about in this room is really about the social factors and the love for luxury, and that point's been addressed quite well over the last 2 days as well. But just what I try to emphasise is that the social factors and the desire for luxury goods in China is much higher than other parts of the world. I'm Australian. People in Australia don't really spend much money on luxury goods, so it's really the demand for luxury goods in China and Hong Kong and Taiwan and Singapore is super high versus Australia, the UK, the US, etc. And then the third driver is really the increasing supply of stores. As the luxury goods companies start opening more stores in China, that's going to stimulate more demand for products. And of course, tourism. As tourism increases and people travel more to Hong Kong, Macau, Europe, US, etc., that's going to stimulate demand. Actually, that reminds me of a point I forgot to mention earlier on, which is about this booming tourism. Now, again, another reason why the luxury goods sector is so interesting is that to capture the growth, the luxury goods companies don't need to do as much as other companies, okay, which you're going to find it hard to understand, right? If you're a sporting goods company in China, if you want to get growth, you have to open 100,000 stores a year. You need to go into Tier 3, Tier 4, Tier 5, Tier 6 cities. And of course, when you open more stores, that's going to drag on your profit because opening stores cost money. But what's happening at the moment is all these Chinese people are travelling to Europe. So the stores in Europe are already there. If you're a Prada, you're Gucci, you're Louis Vuitton, if you've got 4 stores in London, you don't need to open 8 stores. The stores are there. So what's happening is the luxury goods sector is capturing all this incremental demand without spending much money. So this is why the earnings growth for the luxury goods sector is actually so attractive versus other industries. So the message is that you guys are in a pretty good situation. Probably don't really see that sometimes. Okay, so I want to talk about what CLSA has been doing in terms of IPOs. So we've worked on 2 IPOs over the last 2 years for consumer, Prada and L'Occitane. It took up a lot of our time recently, and then also we did IPOs for the gaming sector, which also look at MGM China, Wynn Macau and Sands China. And then the other IPOs that have occurred recently is Chow Tai Fook, Coach, which is a dual listing, and then Samsonite. Some would maybe argue that's not pure luxury goods, but it's a branded consumer goods company. So there's been a huge interest in listing companies in Asia recently, which for us, from a business point of view, is very exciting. I think there's a few reasons why global luxury goods companies are listing in Asia. I think the first reason is that there's of course a lot of capital available in Asia right now that's being attracted to the luxury goods sector. Also the valuation multiples for some of these companies could potentially be higher if they're listed in Asia. And I think the execution risk around an IPO in Hong Kong and in Singapore would actually be lower than what it would be in Italy. But I know that for the Italians in this room, they're probably upset that Prada listed in Hong Kong and not Italy. I apologise for that. And then I think going forward, I think we'll expect to see a lot more IPOs in Hong Kong. And there's been rumours that Graf, people would know that's one of the most highest end jewellery brands, along with Harry Winston. They're looking to do an IPO in Hong Kong. There's been talk about Ferrari, and we believe there's going to be a lot more companies looking to list in Hong Kong going forward. And if anyone's interested in doing an IPO of their company, then please talk to me. Okay, so Prada IPO, this is very exciting for us because typically the companies that manage IPOs would be the names like Goldman Sachs and Morgan Stanley and JP Morgan, etc. So for CLSA to be involved in the IPO was very exciting for us. The deal was considered to be the best IPO globally in 2011, so that's quite an honour. In terms of who worked on that, it was CLSA, Goldman Sachs and 2 Italian banks, but actually ourselves were the lead advisors to Prada. So we're very pleased with how that worked. And then the deal was oversubscribed by 200%, so a huge amount of interest. And then in terms of, while it's listing in Hong Kong still, the shareholders that were interested in the deal were from the US and Europe as well. And the stock actually has been a bit weaker recently, but the financial markets this year have been terrible, and the stock has performed relatively okay versus its peer group. So I sort of could talk for a long time about why we recommended people to buy Prada. I'm probably not going to go into too much detail about Prada because I'm not here necessarily to promote the company. But of course Prada has a strong brand heritage. It goes back to 1913. A very innovative culture. I think people would be aware of that in terms of the products and also the stores. Again, I think in terms of products that meet customer desires, that's becoming, as people have mentioned the last 2 days, that this is becoming an important point. So I think customers are becoming more focused on the actual product. And then Prada's got a good track record of developing very interesting stores. And then we've got a picture of the store here in Tokyo, and that actually is one street away from where I used to live, so I used to look at that store every day. Great store. And then the business model, I think our view in the luxury goods sector is that Louis Vuitton as a brand has really created the best business model in terms of really focusing 100% on its own stores. We think that's the right model for luxury goods companies, particularly if you're focusing on leather goods. And also, they have a policy of not discounting, they've got the right product mix. So we really think that Arnaud is the leader in terms of developing the right business model. But we think that the legacy for Bertelli would be that he's industrialised the luxury goods sector. I think Prada have done a very good job in terms of the way they organise their manufacturing, and they do utilise manufacturing from places outside Italy, which is sometimes controversial. But the products they do produce outside Italy, whether it's in Eastern Europe or in Asia, tends to be the lower end products. So I think they've done a good job on the industrial side as well. But essentially what investors want when they're looking at luxury goods companies is growth. Of course the growth in terms of revenues at the industry level is quite attractive, and I've talked about earnings already as well. But for Prada, we think it's going to outgrow other companies in the sector, take market share, because they've had financial problems over the last few years, which have now been fixed, and therefore there's a lot of scope for Prada to catch up to other luxury goods companies in terms of store counts. And you can see in these charts that Prada has got a lower number of stores than Gucci, which I think is the key reference point in nearly all of its markets. So a lot of opportunity to catch up. And then here's just another chart showing the store count increasing quite aggressively. Okay, so maybe what I've got to offer, which is different from other people, is opportunities to make money.